Welcome to Talk Tickers. We're here to unpack the latest earnings reports, turning dense data into clear, actionable insights for you.
And today we're diving into HealthEquity's Q2 fiscal year 2026 earnings call. Definitely a report that resonated with the market.
Yeah, it certainly did. So this deep dive, we're focusing on HealthEquity's financials, some really groundbreaking legislative changes impacting health savings accounts, and their strategic tech investments.
Exactly. We'll explore how all these pieces fit together, what's driving their growth, and what it means for the bigger picture in healthcare finance.
Okay, let's jump right in. HealthEquity delivered a notably strong second quarter. The headline numbers definitely turned some heads.
They absolutely did. Revenue climbed to $325.8 million. That's up 9% year over year. And it beat the consensus estimates by about 2.2%.
Very solid beat.
Yeah, and even more impressive, the non-GAAP EPS came in at $1.08. That's a significant jump, 26% year over year, and it beat estimates by a healthy 17.4%.
Wow, 17.4%. That's not just squeaking by. And the profitability metrics, were they just as robust?
Oh, absolutely.
Yeah.
This is where you really see the operational strength. They hit a record gross margin of 71%.
71%, record gross margin.
And a near record adjusted EBITDA margin of 46%. Adjusted EBITDA itself reached $151.1 million, up 18% year over year.
So strong top line flowing through to really strong profitability. It suggests, good management, favorable mix.
Precisely. Effective operational management, good revenue mix, it's all clicking there.
And what about the platform itself, the accounts, the assets? Did we see solid expansion there too?
Yes, definitely solid. HealthEquity now serves 10.0 million HSAs. That's up 6% from last year. 10
million HSAs.
And they manage 17.1 million total accounts overall. HSA assets grew 12% to $33.1 billion.
Okay.
But here's a key point. Invested HSA assets saw particularly strong growth, up 23% to $16.1 billion.
23% growth in invested assets. That suggests members are getting more engaged, right? Not just holding cash.
Exactly. It points to sustained momentum and deeper engagement, a really positive sign.
Okay, let's unpack one of the, I think, biggest stories from this call, these legislative changes for HSAs. You mentioned it wasn't just a small tweak.
Yeah, this is really significant. There was a budget bill passed back in July, and it introduces the largest expansion of HSA eligibility and uses in, 2 decades.
2 decades. So this isn't just tinkering around the edges.
Not at all. It's a fundamental structural shift in how HSAs can be used and who can get them.
So break it down for us. What does this actually mean for consumers, for the market?
Okay, so for starters, direct primary care DPC arrangements and also low-cost telehealth services. They're now permitted before someone meets their deductible.
Ah, okay. That used to be a blocker, right?
It could disqualify you from HSA eligibility before. So this gives people and plan designers much more flexibility. You can use that quick telehealth visit without jeopardizing your HSA status.
Right. That makes sense. But you said there was something even bigger for the addressable market.
Yes, this is the massive part. Starting January 1st, 2026, all individual bronze and catastrophic plans sold on the ACA exchanges. They become eligible to be paired with HSAs.
All of them. Bronze and catastrophic.
All of them. Think about it right now. Something like 90% of the, 7 million plus people in bronze plans weren't eligible for an HSA.
Wow.
This change alone could open up HSA access to an extra 3 to 4 million American families. It's a huge expansion of their potential customer base.
3 to 4 million families potentially coming into the HSA world. And HealthEquity, they're not just sitting back and waiting for this to happen.
No, definitely not. They're already making moves. Management said they plan to proactively redesign their whole enrollment and onboarding process specifically for these newly eligible folks.
Makes sense. Tailor it.
Exactly. And launch targeted marketing campaigns to make sure people know about this. They see it as a multi-year structural tailwind. It's going to drive new HSAs and grow those custodial balances for years to come.
So beyond policy, HealthEquity is also clearly leaning heavily into technology, driving efficiency, better member experience. How are these investments actually showing up?
Yeah, they're making really significant strides here, especially with AI and focusing on mobile. For example, they have this expedited claim system. It's actually won awards.
Okay.
It uses AI to automate the claims adjudication process. So it processes millions in reimbursements faster, members are happier, and it cuts their internal processing costs. It's a real win-win.
And it sounds like their AI ambitions go further than just claims.
Oh, yeah. They talked about using what they call agentic AI in their voice channels. Think of AI that can actually take action to solve problems.
Right, not just answer simple questions.
Exactly. The goal is more automation, faster service, getting member inquiries handled accurately, and hopefully cutting down those annoying call wait times. Plus, their HS Answers AI education tool got some industry recognition too.
It really sounds like a full court press on the tech front, mobile app, AI.
It really is. They've been pushing their mobile app hard. 1.7 million downloads now. They're adding passkey authentication too.
Passwordless.
Nice.
Yeah.
More seamless, more secure. And even new members enrolling during open enrollment can set up their HSA right on the app. Super smooth.
What about the back end, the stuff users don't see but makes everything work?
Good question. They finished migrating their main platform, V5, to be 100% cloud-based.
Okay, and what did that achieve?
Pretty dramatic results, actually. They reported 92% faster response times,
Wow.
5 times more stability, and an 80% drop in delays. And because of these efficiencies, they actually managed a 9% reduction in headcount year over year while improving service levels.
That's impressive. Doing more with less, powered by tech.
Exactly. Technology driving real productivity gains.
And security, obviously crucial when you're handling billions in assets. Any progress there?
Yes, significant progress. Direct fraud service costs came down quite a bit. They were $3 million in Q1, but the exit run rate in Q2 was near their target, just 1 basis point of total HSA assets per year.
Okay, 1 basis point, so a tiny fraction.
Tiny fraction. Their goal is to get that fraud impact normalized by the end of fiscal year 2026. Shows they're getting a good handle on it.
Now, the company acknowledged the job market has softened a bit, employment growth down quite a bit year over year. Yet HealthEquity still outperformed expectations. What's driving that resilience?
Yeah, that's a key point. It really highlights their market leadership and strategic focus.
Yeah.
They still opened 163,000 new HSAs in the quarter.
Which, given the context, is pretty strong.
Very strong, considering the macro environment. It really comes down to, strong sales pipelines, good client relationships they've built over time, and those improvements in member satisfaction we talked about. Their market position is helping them weather the slowdown.
And it's not just about getting new accounts in the door, right? There's this whole dimension of getting members more engaged.
Precisely. That's a huge part of the long-term strategy. Right now, only about 4% of members contribute the maximum allowed to their HSAs.
Only 4%.
Wow. Yeah, and only 8% are actually investing their HSA funds. So there's this massive untapped potential to educate members, encourage higher contributions, get them investing using that mobile experience we discussed.
Right, unlock the full potential of the HSA.
Exactly. They also have this analyzer product that helps employers design smarter health plans, ones that naturally encourage people to adopt and really use their HSAs effectively. It's about maximizing value in the existing member base, not just adding new names.
Let's talk about interest rates. Custodial revenue is a big piece of their business. How are they managing the risk if rates fluctuate?
They're being quite proactive here. They're using treasury bond forward contracts, basically locking in future rates.
Okay, hedging.
Exactly. They've entered into contracts covering about $1.2 billion, mostly for assets maturing in 2026 and early 2027.
And what kind of rate are they locking in?
It effectively locks in an average rate just over 4% on the underlying 5-year treasuries. Then they anticipate adding their usual spread, about 75 basis points, for enhanced rates. So they're securing a rate around 4.75% for those hedged assets.
So basically trying to smooth out potential volatility in interest income.
Precisely. It de-risks that part of the business. They're projecting an average yield on all HSA cash of about 3.5% for fiscal 26. Incorporating this hedging, it provides more predictability.
And there was also a tax benefit mentioned in that budget bill, something about R&E expenses.
Yeah, this is another nice tailwind. That same bill allows an immediate tax deduction for domestic research and experimental R&E expenses starting in fiscal 26.
And what's the bottom line impact of that?
It's expected to cut their federal cash taxes by somewhere between $65 and $75 million over the next 2 fiscal years.
That's a significant chunk of cash.
It really is. Boost their cash flow considerably, freeing up money for, strategic investments, paying down debt, buying back shares, all without really hurting their reported earnings per share. Good financial flexibility.
So with all these positive, strong quarter legislative tailwinds, tech progress, hedging, tax benefits, it's really no surprise they raised their guidance for the full fiscal year 2026. What are the new targets?
That's right. Guidance is up across the board. Revenue is now projected between $1.29 and $1.31 billion.
Okay.
Non-GAAP EPS expected between $3.74 and $3.91 per share. And adjusted EBITDA is forecast in the range of $540 to $560 million.
So a confident outlook reflecting everything we've discussed, the performance, the policy changes, the investment.
Exactly. It reflects the strong Q2, those record margins, the huge policy tailwinds, plus their ongoing investments in tech, security, sales, marketing.
Yeah.
And it also includes plans for more share buybacks under their existing authorization. Signals real confidence.
Yeah, absolutely. This earnings call, this deep dive, it really paints a picture of a company firing on multiple cylinders, wouldn't you say?
I would. HealthEquity isn't just, participating in the market. They're actively shaping it. That legislative expansion for HSAs is truly a game changer. It fundamentally grows their market and sets up this multi-year growth path. It's compelling.
And that dual-focused tech innovation like AI and mobile, combined with really disciplined cost management, it's clearly working. Better experience for members, expanding margins for the company, powerful combination.
It really is. And add to that their proactive risk management with the rate hedging and a smart capital allocation strategy balancing investment with shareholder returns through buybacks and debt reduction. It shows sound financial stewardship.
Right. And that focus on deeper member engagement, getting people to max out contributions to invest, that shows a sophisticated long-term view. It's not just about grabbing accounts, it's about maximizing the value within that growing base.
Well put. It's about building sustainable long-term value.
All right, it's that time, our This Is Not Financial Advice segment. We put on our hypothetical investment committee hats and pitch an outrageous but plausible trade idea based on what we've just discussed. Remember, folks? Just thought experiments.
Okay, given HealthEquity's momentum, and especially those legislative tailwinds, here are a couple of, let's say, adventurous concepts.
Idea one, the HSA land grab long equity play with a twist. Lay it out for us.
Okay, so the basic idea, you go long HealthEquity stock, HQY,
Yeah.
You're betting it outperforms the overall healthcare sector, maybe benchmarked against something like the XLV ETF, standard enough.
Right. But the twist.
The twist is, at the same time, you consider taking a long position in a carefully selected basket of small cap insurance providers. Specifically, one's focused on high deductible health plans, the kind that will benefit most from being newly HSA eligible on the ACA exchanges.
So you're betting on both the infrastructure provider, HealthEquity, and the direct beneficiaries of the new plan demand.
Exactly. The thesis is HQY captures the service and custodial fees from the bigger market. But these smaller insurers see a potentially disproportionate jump in new signups for their plans. It's like a symbiotic bet. HQY's growth validates the insurer's product demand, and vice versa. You're trying to front-run the whole ecosystem build-out.
Interesting. Playing both sides of the legislative coin. Okay, what's idea two? You called it the custodial yield arbitrage. Sounds complex.
Yeah, this one's definitely more for the quant-minded folks. It hinges on those forward contracts HealthEquity used to lock in future custodial rates around 4.75%.
Right, the hedging we discussed.
So the market might still be overly focused on potential rate cuts broadly. But for this specific $1.2 billion chunk of HealthEquity's assets, their rate is largely locked in. The trade idea involves constructing a synthetic long position on HealthEquity's custodial revenue stream, maybe using a complex option strategy like a box spread, possibly combined with interest rate futures.
Okay, slow down. So the bet is the market isn't fully appreciating the stability of that specific locked-in revenue.
That's the core idea. You're betting the market is underpricing the stability and maybe even the future growth tied to that hedged portion, especially if general rate forecasts for 2026 end up being lower than the roughly 4.75% HealthEquity is secured. You're trying to arbitrage the gap between broad market rate expectations and HealthEquity's specific hedged reality for a big slice of their future income.
Definitely requires precision, as you said, exploiting a potential disconnect between perception and hedged reality. Very niche.
Highly speculative, but conceptually interesting, given their explicit hedging disclosure.
Okay, fascinating ideas. Again, folks, purely hypothetical. So wrapping up on HealthEquity's Q2 FY26 results.
Yeah, it really underscores a company in a very strong position. They're executing well internally, and they've got these significant external tailwinds, especially that huge HSA expansion. Combined with the AI and mobile investments, it really does set them on an exciting multi-year path.
Agreed. We saw how it's driving robust financials and hopefully a more engaged member base over time.
And for you, our listener, thinking beyond just HealthEquity, consider the ripple effects. What does broader access to HSAs mean for how individuals manage healthcare costs? Does it fundamentally shift responsibility, choice, spending habits in the U.S.?
Yeah, it's a provocative thought. How does this democratization of HSAs reshape personal healthcare finance? Lots to mull over there.
Definitely food for thought.
Well, thank you for joining us on Talk Tickers. Remember, this information is purely for educational purposes. It should absolutely not be considered financial advice. Always do your own research, your own due diligence, and please consult with a qualified financial professional before making any investment decisions.
We'd love to hear your thoughts. Connect with us on social media. Let us know what you think about HealthEquity's future and these trends. Until next time.